Assalamualaikum warahmatullahi wabarakatuh. For introduction, this report delves into the various aspects of capital structure with thorough understanding of the topic. Along with the overview of the capital structure, this report involves the factors that affect capital structure, decisions such as in terms of business risk, financial flexibility, firm's market condition, and asset structure. In corporate finance, capital structure influences a company's risk level, ability to secure the firm from any unexpected downturns, also enables company to lower financing costs, manage risk, and also maintain financial flexibility.
Next, we move on to the second part, which is capital structure. What is capital structure? Capital structure refers to the amount of debt and/or equity employed by a firm to fund its operation and finance its assets. Both debt and equity are understood as the long-term sources of financing. The managers need to ensure they attain an optimal combination between these two sources of capital so that they can achieve the right capital structure. So here is the diagram of capital structure that include both debt and equity. So debt and equity are two of the main ways a company can raise money. Common techniques used by analysts include debt ratio, which depicts the extent to which the organization relies on total debt in relation to total asset. A second form is the ratio of long-term debt to total capital, which is the sum of long-term debt, preferred share, and common stock. This ratio assists in determining the risk that is inherent with the borrowing activities in a particular company. So, businesses comprising high level of debt financing are risky to investors. Equity provides external investors with an ownership interest in the company. However, it is usually more expensive than debt financing, especially where the interest rates are low. The next part is how to determine optimal capital structure. The optimal capital structure of a firm is the best mix of debt and equity financing that maximizes the market value while minimizing its cost of capital. Also, often defined as the proportion of debt and equity that result in the lowest weighted average cost of capital. The company has to identify the blend of debt optimal, where the marginal benefit of debt equals to marginal cost by calculating WACC. So, refer to the diagram, we can see that while deciding on the optimal capital structure, companies can issue either more debt or equity. There are several factors to determine the optimal capital structure. The first one is corporate life cycle. The life cycle stage that a firm is at sometimes greatly determine its optionality to incur debt at reasonable rate. On the other hand, early-stage companies rarely take traditional debt on their balance sheets because they may not have the steady earnings yet. Second is tax deductibility of interest. It is often associated with a greater risk, calls for a greater rate of return. And the last factor is business risk. It is the risk that comes with the operating performance of the firm after leaving out the effect of debt. The higher a firm's business risk, the less of financial leverage in the optimum capital structure.
Thus, the affecting capital structure and also capital structure decisions, there are 5 of them, such as business risk, financial flexibility, profitability, asset structure, and also market conditions. We will go through them one by one. For the business risk, companies with higher business risk would handle greater uncertainty in their business cash flow. This situation will make them avoid any high level of debts to protect their firm from financial distress during unexpected downturns that could lead them to bankruptcy. Meanwhile, for the lower business risk firm, they would leverage more debt due to their stable and predictable cash flow. In a market condition, there are 2 markets involved, which are low interest rate environment and also bullish market. In the low interest rate environment, companies may find it encouraging to borrow more money because debt financing is cheaper in that period. Meanwhile, companies may issue more equity in the bullish market due to the favorable prices. Next, for the asset structure, Companies with larger tangible asset allow firms to secure more debt as low interest rate. This is because intangible asset allow companies to use them as collateral to reduce the risk for lenders. Meanwhile, for companies with fewer tangible asset may not secure debt but rely more on equity financing. In terms of profitability, companies with high and secure profit allow them to secure equity at favorable rates. This is because profitable companies have sufficient return earnings to grow their funds without needing to secure debt. However, there are still some companies that prefer debt over equity as a protection from tax, since interest expenses are tax deductible. For the fifth one, which is financial flexibility, some companies that prioritize financial flexibility always maintain its sustainability in the industry by limiting its debt usage to seize opportunities without being deprived of debt obligations. This company usually avoid taking too much debt to allow them to access more debt in the future if needed. Therefore, financial flexibility allows companies to respond well to unexpected economic downturns that may affect capital structure decisions. Next, we will look at the financial distress in capital structure. Financial distress happens when a company struggles to pay back to their creditors. Financial distress can be caused by two factors, which are internal factors and also external factors. Internal factors is when company has direct control to manage and monitor them. For instance, we have aggressive investment that is made by a company that result in the problem of cash shortage or high financial leverage. When the financial leverage is too high, the company's interest payment will eventually increase due to the too much debt in the company. And the second one is unrealistic strategy plannings. This happens when the company plans an unrealistic long-term strategy that may occur the financial distress due to the induced company's excessive operations. Next, for the external factors, this is the factors that is beyond company control to manage and monitor them. For example, we have economic downturns or recessions when the company lost revenue. Thus, companies might take out large loans that will later raise the company's cost to repay back. For the financial distress indicators, there are two indicators concluded in the report, which are the first one financial ratios and the second one is by operational indicators. Through financial ratios, we have liquidity ratios that measure companies' liquidity to settle its short-term obligations. In this liquidity ratio, higher ratio is much preferred because indicates that the company is able to settle its short-term debt obligations. For example, the method that we use in this indicator is current ratio, which is current asset divided by current liabilities. In the financial ratio, so we have leverage ratio, that is to measure the extent to which the firm uses debt to finance its investment and how well the firm meets its interest payment obligations. In this method, we have debt ratio equal to total debt divided by total asset. And the last one is operational indicators. We have size of the firm. Size of the firm illustrates how big the total asset owned by the company, which means big total assets show positive sign to the creditors because the companies would be able to pay off its obligation. And last one, we have operating cash flow, which means that good cash flow indicates that the companies would be able to carry out its obligation that will prevent financial distress. This is also an indicator for creditors to trust the company.
In capital structure, tax effects play a critical role because of interest on debt is tax deductible, which providing a valuable tax shield that lowers a firm's taxable income and overall tax burden. This makes debt financing attractive, especially for companies with steady cash flows as they can maximize the benefits of this tax shield. However, there is a trade-off. While debt reduces taxes, when excessive debt can heighten financial distress and insolvency risk. The optimal capital structure balances the tax advantages of debt with the potential costs of financial trouble. Thus, firms consider tax effects in tandem with financial distress costs, especially as tax rates or financial conditions change.
Let's continue with the agency costs. Now, what exactly are these? Simply put, agency costs arise when the interests of a company's management and its shareholders don't align perfectly. For example, the management might focus on strategies that increase their own control or perks, while shareholders care most about the strategies that increase the company's stock value. When management doesn't act in ways that match shareholders' goals, the companies incurs what we call agency costs, basically expenses or losses due to misalignment. Agency costs always happen because of this conflict of interest. For instance, let's say the management wants to pursue a merger that increases their power and control, but shareholders prefer they use that money to pay dividends or invest in higher return projects. When there is this kind of tension of conflicting priorities, agency costs arise because resources are not being used in a way that maximizes shareholder value. There are three main types of agency costs that companies deal with. First, monitoring costs. Shareholders always spend money on things like audits or hiring consultants to monitor management actions. This helps keep management in check but also costs the company money. Second, bonding costs. To align management's interests with the company's, many firms offer performance-based pay, like stock options. This is great for motivations, but involves setting up system and can be costly to manage. Third, residual loss. Even after all this monitoring and bonding, there is usually still some gap between the value shareholders could ideally get and the value they actually get. This loss is what we call residual loss. So, how do companies reduce agency costs? First, with debt financing. When companies use debt, it creates a financial discipline because management has to focus on generating cash flow to pay off the debt, leaving less room for spending on wasteful projects. Second, incentives for managers. By offering stock options or performance bonuses, management's personal financial success becomes tied to the company's performance. This helps align their interests with shareholders. Third, strong corporate governance. Having an independent board or active shareholders watching over management also helps ensure decisions are in the company's best interest. Impact on capital structure. Agency costs affect how companies choose between debt and equity. When agency costs are high, companies tend to choose debt because it requires regular payments that limit extra cash. This forces management to make more disciplined financial choices. On the other hand, equity provides flexibility but might lead to overspending since there is no strict repayment schedule. Now, let's move on to the pecking order theory. This theory, developed by Myers and Mellove in 1984, suggests that companies prefer certain financing options over others in a specific order. According to this theory, companies first try to fund their investment with retained earnings, then with a debt, and only as a last resort with equity. The reason behind this hierarchy is something called asymmetric information. Essentially, managers know more about the company's future and risk than outside investors do. Because of this information gap, external investors view financing from outside sources as riskier. They often demand a higher return to offset the risk, which makes it costly to raise funds through debt or equity. Let's look at the 3 steps in the pecking order. First, retained earnings. Companies start with their own internal funds because it is the least risky and doesn't need outside approval or scrutiny. Second, debt financing. If internal funds are not enough, companies go for debt next. It is generally cheaper than equity, doesn't dilute ownership, and won't negatively impact stock prices. Third, equity financing. Equity is the least preferred choice because it dilutes ownership and can send signals to the market that the stock might be overvalued, which could impact the share price negatively. According to the pecking order theory, there is not an optimal debt to equity ratio. Instead, companies choose based on their specific financial situation and investment needs. For example, companies with stable cash flow may rely mostly on internal funds, while high-growth firms need to rely on a mix of debt and equity over time. Agency programs also play a role in this financing hierarchy. Companies with low cash flow but high investment needs might prioritize debt because it is cheaper and doesn't dilute ownership. However, if they reach their debt capacity, they may have no choice but to turn to equity. So, in essence, the pecking order theory is about practical financing choices that fit each company's unique needs and circumstances rather than finding a fixed debt to equity balance.
The signaling hypothesis suggests that a firm's financing choices send signals to the market, particularly because of information asymmetry, where managers know more about the firm's prospects than investors. Taking on debt can signal to investors that management is confident in future cash flows, which potentially boosting the stock price. In contrast, issuing new equity might suggest uncertainty or lower expected cash flows, which possibly leading to a drop in share value. Consequently, firms may prefer debt over equity to avoid sending negative signals. By carefully considering these signals, managers aim to convey confidence and stability in their capital structure decisions.